Welcome to our deep dive on the stealth killer of the Backdoor Roth strategy, the Pro-Rata Rule. In this video, we'll explain how a small, forgotten pre-tax IRA balance can transform an otherwise clean Backdoor Roth into a taxable headache. We'll cover what the Pro-Rata Rule is, how it's applied, a worked example, how to fix past mistakes, and what to do to prevent them in the future. Let's get started. Here's our agenda. First, we'll define the Backdoor Roth strategy and how it's supposed to work. Next, we'll unpack the IRS Pro-Rata Rule and why it matters. Then, we'll walk through a concrete numbers example. After that, we'll discuss how to fix past mistakes if you already violated the rule. We'll compare two cleanup options and finish with a practical checklist and a couple of quick quizzes. Let's move to an important disclaimer before we begin. This content is educational and not tax, legal, or financial advice. Your situation is unique, and tax law can change. Consult a qualified CPA, EA, or tax attorney before taking action. This video focuses on U.S. federal rules related to IRAs and Roth conversions. The Backdoor Roth is a two-step process. You make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA. The key idea is to avoid income limits on direct Roth IRA contributions. However, the strategy only stays clean if you have zero pre-tax IRA balances across all your traditional, SEP, and SIMPLE IRAs on December 31st of the conversion year. You must track your after-tax basis using Form 8606. That basis is the total of your non-deductible contributions that haven't yet been used to offset taxes on distributions or conversions. The Pro-Rata Rule, also called the IRA Aggregation Rule, requires you to combine or aggregate all of your traditional, SEP, and SIMPLE IRAs when determining how much of a Roth conversion is taxable. If any pre-tax money exists on December 31st of the conversion year, part of your conversion becomes taxable. A simplified expression is that the taxable portion of your conversion is the conversion amount multiplied by the ratio of pre-tax funds to total IRA funds. The non-taxable portion is the conversion amount multiplied by the ratio of after-tax basis to total IRA funds. Employer plans like 401k, 403b, and governmental 457 are not aggregated with IRAs, which is why rolling pre-tax IRA funds into a current employer plan can remove them from this calculation. Form 8606 tracks your after-tax basis, and the official denominator components are taken from year-end IRA values and distributions as specified in Form 8606 instructions. This timeline shows multiple years where a taxpayer performed backdoor Roth conversions while unknowingly holding a small pre-tax IRA balance. In the following year, the error is discovered. The path then branches. One option is to amend prior returns. The other option is to ignore, which is not technically correct. If the taxpayer amends, they gather documents such as Forms 1099-R and 5498. Prepare Form 8606 for each year in chronological order, and file Form 1040X for any year where taxes change. These filings are often mailed. For future compliance, the taxpayer either converts the remaining pre-tax IRA to a Roth and pays the income tax now, or rolls the pre-tax IRA into an employer 401k. Once the December 31st pre-tax IRA balance is zero, they can resume clean backdoor Roth conversions in subsequent years. Here's a simple numerical example. You contribute $6,000 after tax to a traditional IRA and immediately convert $6,000 to a Roth. However, on December 31st, you still have $24,000 of pre-tax money in another IRA. The total aggregated IRA value is $30,000. Your after-tax basis fraction is $6,000 over $30,000, or 20%. Therefore, only 20% of your conversion is non-taxable. The remaining 80% is taxable, which equals $4,800. This is the essence of the Pro-Rata Rule in action. To fix past mistakes, start by identifying the first year the pro-rata violation occurred. Gather Forms 1099-R, 5498, and any previously filed 8606 forms. Amend returns in chronological order, because each year's basis depends on the prior year's ending basis. Prepare or correct Form 8606 for each affected year. File Form 1040X for any year where the tax amount changes, and include the corrected 8606. Many of these corrections are mailed and can take a long time to process. Be aware that penalties and interest may be assessed on underpaid taxes. Keep careful documentation of your adjusted basis each year to prevent double taxation. There are two primary cleanup options. First, you can convert the pre-tax IRA balance to a Roth IRA now, paying income tax on the conversion. This cleans the slate and simplifies your accounts, but it accelerates taxes into the current year and may affect your tax bracket or credits. Second, you can roll the pre-tax IRA into a current employer's plan, such as a 401k or 403b, if the plan accepts roll-ins. Employer plan balances are not included in IRA aggregation, which preserves clean backdoor Roth conversions. Evaluate plan fees, investment choices, and eligibility before proceeding. Quiz time. Which accounts are included in the IRS pro-rata aggregation for Roth conversions? A. Only the IRA used for the conversion. B. All traditional, SEP, and SIMPLE IRAs you own. C. Only your current employer 401k. D. Only Roth IRAs. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The Pro-Rata Rule aggregates all of your traditional, SEP, and SIMPLE IRAs. Employer plans such as 401k, 403b, and governmental 457 are not included, and Roth IRAs are not part of the aggregation for this calculation. Second quiz. When is the IRA balance measured for the Pro-Rata Rule? A. On the day you convert. B. On April 15th of the following year. Always day. C. On December 31st of the conversion year. D. Whenever your custodian issues Form 1099-R. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. The Pro-Rata Rule uses a snapshot of your IRA balances as of December 31st of the conversion year to determine the taxable and non-taxable portions of your conversion. Follow this annual checklist. First, verify that your pre-tax IRA balances across all traditional, SEP, and SIMPLE IRAs are zero before you execute a conversion. If pre-tax funds exist, either convert them to a Roth and pay the tax, or roll them into a current employer's plan. Then, make the non-deductible traditional IRA contribution and convert to a Roth promptly. File Form 8606 accurately and track your basis each year. Keep your Forms 1099-R and 5498 for your records. Finally, always recheck your balances each December before doing any conversion. This table summarizes the key forms. Form 8606 tracks your non-deductible basis and calculates the taxable and non-taxable portions of conversions. It is filed with your tax return, and in some cases can be filed by itself to correct prior omissions. Form 1040X is used to amend previously filed returns when the tax changes. Form 1099-R reports distributions and conversions from your IRA and is issued by your custodian. Form 5498 reports IRA contributions and the year-end fair market value. Your custodian issues it for your records. The key points are: the Pro-Rata Rule aggregates all traditional, SEP, and SIMPLE IRAs as of December 31st. Any pre-tax IRA balance makes part of your conversion taxable. To fix past mistakes, amend chronologically and use Form 8606 and Form 1040X where taxes change. For future compliance, either convert the pre-tax funds to Roth or roll them into an employer plan to remove them from aggregation. Always verify a zero pre-tax IRA balance before each backdoor Roth conversion. In summary, due diligence is essential because the Pro-Rata Rule is unforgiving. Eliminate pre-tax IRA balances before any backdoor Roth conversion. Choose a cleanup path that fits your tax situation. Convert to Roth now or roll into a current employer plan. Document thoroughly and file Form 8606 every year. If you're unsure, consult a qualified tax professional. Thanks for watching. If this helped you avoid a tax trap, please like this video, share it with a friend, and subscribe for more practical tax and investing content. Post your questions and experiences in the comments so we can all learn together.